Welcome back, savvy viewers. Today, we're diving deep into the fascinating world of money. Have you ever paused to consider what those crisp bills or digital numbers really represent? How they hold power to shape economies, impact lives, and quite literally make the world go round? Today, we're pulling back the curtain to reveal the hidden mechanisms of money. Let's start at the very beginning. What is money? It's not just a piece of paper or a number on a screen. It's a tool, a medium of exchange that allows us to trade goods and services. This might seem simple, but it's a concept that revolutionized human societies. Before the advent of money, people relied on the barter system, swapping goods and services directly. Imagine trying to trade a herd of sheep for a new car or a pile of apples for a haircut. Not very practical, right? That's why money was introduced, to simplify these transactions. Now, money performs three key functions. First, it serves as a medium of exchange. It's a universally accepted token that we can trade for goods and services. This eliminates the need for a double coincidence of wants, which was the major drawback of the barter system. Second, it acts as a unit of account. It provides a standard measure that allows us to compare the value of different goods and services. This way, we can easily determine prices and make informed decisions. And lastly, money functions as a store of value. It allows us to save and accumulate wealth over time. Whether it's stashed under a mattress in a bank or invested in assets, money represents a means to secure our future. So there you have it. Money, in its essence, is a medium of exchange, a unit of account, and a store of value. But as we'll discover, the world of money is far more intricate and fascinating than it initially appears. Now, let's break down the three main functions of money: a medium of exchange, a unit of account, and a store of value. As a medium of exchange, money allows us to easily trade goods and services without the hassle of finding someone who wants what we have. It's a universal language that simplifies transactions, and it's one of the three main functions of money. This brings us to the second function of money, being a unit of account. This might sound a bit complex, but it's actually straightforward. Money provides a standard measure, a yardstick, if you will, that allows us to judge the worth of different goods and services. This makes it easier for us to determine prices and make informed decisions. For instance, we can easily compare whether a dozen apples is worth more or less than a pair of socks. Without money, making such comparisons would be much more difficult. The third function of money is as a store of value. This function is particularly important because it enables us to save and accumulate wealth over time. With money, we can store our purchasing power for future use. This could be as simple as saving money in a bank account for a rainy day, or as complex as investing in assets like stocks or real estate. So to recap, money serves three key functions. It acts as a medium of exchange, making transactions easier. It serves as a unit of account, providing a standard measure of value, and it functions as a store of value, allowing us to save and accumulate wealth over time. Now, you might be wondering, where does all this money come from? It's not just about printing more bills. Money creation in the modern economy is largely facilitated by banks through a process known as fractional reserve banking. But that's a topic for another time, and we'll delve into it in our next segment. For now, just remember that money, in all its complexity, is essentially a tool that facilitates trade, measures value, and stores wealth. By understanding these functions, you can better navigate the world of finance and make more informed decisions about your own money. But How is money created? Well, it's not as simple as printing more bills. The majority of money in the modern economy is created by banks through a process called fractional reserve banking. Quite a mouthful, isn't it? But fear not, we're going to break it down in simple terms. Imagine you're depositing $100 in a bank. The bank is required by law to keep a fraction of that deposit, say 10% in reserve. This is the fractional reserve. The rest, $90 in our case, can be loaned out to other customers. Now here's where the magic happens. When the bank loans out that $90, it doesn't disappear from the original $100 you deposited. It essentially creates a new $90 that didn't exist before, increasing the total money supply. This is how banks create money. But what happens when the person who took the $90 loan deposits it back into the bank? The process repeats. The bank keeps a fraction of that deposit in reserve and loans out the rest. As this process continues, the initial $100 you deposited can theoretically create up to $1,000 in the economy. That's the power of fractional reserve banking. Now you might be thinking, wait a minute, can banks just create unlimited money then? Well, not quite. This is where central banks come in. Central banks like the Federal Reserve in the United States set the reserve requirement, or the fraction of deposits that banks must keep in reserve. By adjusting this requirement, central banks can control how much money banks can create and thus manage the overall money supply in the economy. Central banks also play a crucial role in setting interest rates, which influence how much people borrow and save, further impacting the money supply. So, while it might seem like banks have the power to create money out of thin air, it's actually a carefully regulated process overseen by central banks. Now, let's talk about the role of central banks like the Federal Reserve in the United States in controlling the money supply and regulating the economy. Central banks play a crucial role in managing the money supply, setting interest rates, and regulating financial institutions. These institutions, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, are the backbone of any economy. Let's consider the money supply. Central banks can influence the amount of money circulating in the economy through a process known as open market operations. This involves buying or selling government bonds. When a central bank buys these bonds, it injects money into the economy. Conversely, selling bonds removes money from the economy. This balance is crucial for maintaining economic stability. Then there's the power to set interest rates. Interest rates can be thought of as the cost of borrowing money. By adjusting these rates, central banks can encourage or discourage spending. For example, when the economy is sluggish, a central bank might lower interest rates. This makes borrowing cheaper, encouraging businesses and individuals to take out loans and spend more, stimulating economic growth. On the other hand, when the economy is overheating and there's a risk of inflation, the central bank might raise interest rates. This makes borrowing more expensive, discouraging excessive spending, and helping to cool down the economy. Lastly, central banks regulate financial institutions to ensure they operate in a safe and sound manner. They monitor these institutions, enforce rules, and can step in to prevent bank failures that could have disastrous effects on the economy. By performing these functions, central banks aim to promote economic stability. They strive to maintain a low and steady rate of inflation, keep unemployment at a minimum, and ensure the financial system remains stable and trustworthy. So there you have it, folks. Money may seem complex, but at its core, it's simply a tool that enables economic activity and facilitates trade. By understanding the mechanisms behind it, like the role of central banks, we can better appreciate the intricate system that keeps our economies running smoothly. By understanding how money works, you'll be better equipped to navigate the financial landscape and make informed decisions about your finances. Today, we've unraveled the mysteries of money, exploring its fundamental nature, its functions, and how it's created. We've discovered that money, in its simplest form, is a tool, a medium of exchange that facilitates transactions. We've delved into the three main functions of money. As a medium of exchange, it makes trading goods and services a breeze. As a unit of account, it provides a common measure of value, allowing us to compare the worth of different items. And as a store of value, it lets us save purchasing power for future use. We've also seen how money is created in our modern economy. Is not about printing more bills, but rather a complex process called fractional reserve banking, where banks create new money in the form of loans. And finally, we've discussed the role of central banks in controlling the money supply and regulating the economy. Institutions like the Federal Reserve in the United States are crucial in managing the money supply, setting interest rates, and ensuring the stability of the financial system. Money may seem complex, but once you understand its basic principles, it becomes less daunting. And remember, money is just a tool. It's how you use it that really counts. So keep exploring, keep learning, and keep asking questions. The more you know about how money works, the better you can manage your finances and make decisions that will benefit you in the long run. Thanks for joining me on this journey to demystify the world of money. If you enjoyed this video, don't forget to like, subscribe, and hit that notification bell for more insights on personal finance and economics.